Quick note before we begin. This video is educational analysis of historical data only, not financial advice. Always do your own research. 3 indicators. 1. Break-even coin flip. That's the whole story. The MACD, Parabolic SAR, and 200 EMA stacked together is one of the most popular strategies online, almost always sold with an impressive win rate, proven on a handful of hand-picked trades. So we did the thing almost nobody does. We coded the exact rules and tested them across Bitcoin's entire history. 326 trades, 2 time frames, long and short. Not a few charts, thousands of real trades. Here's what the data actually says. The strategy layers 3 classic indicators, all on default settings. The MACD is the trigger. The Parabolic SAR is the confirmation and the trailing stop. The 200 EMA is the trend filter. Each one is familiar on its own. Stacked together, they are presented as a high-probability system, the kind of setup that supposedly stacks the odds in your favor. Our job here is not to mock the idea, and it's not to defend it either. It's to code the rules faithfully. No interpretation, no discretion, no quietly skipping the losing trades, and then let the full history judge it fairly. That means one fixed set of conditions, applied identically to every candle across every market Bitcoin has ever traded through. Bull runs, crashes, sideways chop. The indicators get their fair trial. The data delivers the verdict. Let's start by understanding exactly what each piece is actually doing. The MACD measures momentum, the gap between 2 moving averages with a slower signal line trailing behind it. When the MACD line crosses above that signal line, momentum is turning up, and in this system that upward cross is the entry trigger. The Parabolic SAR prints a single dot that trails price, sitting below the candles in an uptrend, above them in a downtrend, and it flips to the opposite side the moment the trend reverses. Traders use that dot as a trailing stop, letting it inch closer as the move extends. In this strategy, the stop is placed right at the dot. That matters more than it sounds, because in a calm, steady uptrend, the dot sits very close to price, sometimes only 1% or 2% away. It looks efficient. It looks tight and disciplined. But hold that thought, because how far that stop sits from price is the quiet variable that ends up deciding this entire test. The signals will barely matter. The distance will matter enormously. Keep your eye on the stop. The 200 EMA is a slow-moving line that describes the bigger trend. Price above, it counts as an uptrend. Price below it, a downtrend. Here, it does one job only. It's the filter. Look for longs above the line, shorts below it, and nothing against the trend. Here are the exact rules on a real trade. Go long when price is above the 200 EMA, the MACD crosses up, and the SAR dot sits below the candle. All 3 align, you enter. Stop the trade with a tight fixed cap, a small fraction of a normal day's swing, and set the target the same distance away for a clean 1-to-1 reward to risk. Simple, symmetrical, disciplined on paper. Now watch a real Bitcoin example. The 3 conditions line up cleanly. The signal fires exactly as designed. And then the very next candle? Nothing dramatic, just its ordinary everyday range. Slices straight through that razor-thin stop before the trade has any room to work. No crash, no news, just normal volatility doing normal things. That single moment is the whole problem in miniature, and once you see it, you can't unsee it across hundreds of trades. Now the math, because it sets the bar. With a 1-to-1 reward to risk, stop and target the exact same distance apart, you win precisely as much as you risk on every winner, and lose precisely that much on every loser. So, to come out ahead, you must win more than half your trades. Roughly 50% before fees. That is not our opinion. It's arithmetic the strategy imposes on itself by choosing symmetrical targets. It gives us something rare and clean, an objective pass-fail line the strategy set for itself. Above 50%, there's an edge. Below it, it bleeds. Sitting right at it, it's a coin flip that fees slowly erode. So every claim of a high win rate now has one honest test to survive. The only question left is simple, and the full history can answer it directly. Across 326 real trades, does the win rate actually clear 50%? Let's look. We ran the exact same signals across the whole history. Given the strategy's own natural stop, the parabolic SAR dot itself, the win rate lands at about 49% on the daily and 53% on the 4-hour. Sit with that for a second. That is essentially a coin flip, hovering right around the 50% break-even line. No reliable edge, but no disaster either. Roughly neutral. Now here's the catch, and it's the twist the whole video turns on. The picture only collapses when you jam the stop in tight, well inside a normal day's swing. That single change, same entries, same exits, same trend filter, drags the daily win rate down to about 34%. Nothing about the signals changed, only the distance to the stop did. So the indicators aren't producing a magic edge, but they aren't the culprit behind the failure either. The stop is quietly deciding everything. Let's isolate it and prove it. Here's the honest heart of it, and it's our own experiment. A normal Bitcoin day swings about 4%, so we held the exact same signals fixed and changed just one thing, the stop distance, sweeping it from wide to tight. Leave it out at the parabolic SAR's own dot, around 12%, and the win rate is a coin flip, near 49%. Tighten it to 5%, then 3%, then 2%, all still beyond a normal day's swing, and it stays a coin flip, hovering in the low 50s and high 40s. Then we cross the line. Jam the stop inside the daily noise, down to 1%, and the win rate drops to about 34%. Push to 0.5%, and it collapses further, near 22%. The signals never changed once. Not the entries, not the trend filter, not the time frame. Only the stop moved. Everything you're seeing is one variable. One straight note on how we know any of this is real. You cannot learn a strategy's true behavior from a handful of trades. A small sample can show you almost anything, a dazzling win rate or a dismal one, purely by luck, the same way 5 coin flips can land 4 heads and prove nothing. That's exactly the trap behind most impressive-looking results online, a few cherry-picked charts where the timing happened to work. So we didn't eyeball a few examples and call it evidence. We coded the rules precisely and ran them across Bitcoin's entire history. 326 trades, both the daily and 4-hour timeframes, long and short, and every single stop size you just watched in that sweep. Same logic, applied identically, every time. No skipped losers, no favorable start date. The behavior only stabilizes and tells the truth at scale. And scale is the one thing a highlight reel can never give you. So, is this strategy a scam or a secret weapon? Honestly, neither. And that nuance matters more than a clean verdict. Across 326 real trades, the signals themselves land right around a coin flip. About 49% on the daily, 53% on the 4-hour. No reliable edge you could lean on, but no disaster, quietly draining the account either. What actually decides the outcome isn't the indicators at all, it's the risk management. Jam the stop in tight, inside the day's normal noise, and the win rate bleeds down toward 34% and below, not because the signals got worse, but because ordinary volatility keeps knocking you out before the trade can breathe. Give the stop the room the strategy was designed for, out near the SAR dot, and it holds near break-even. Same entries, wildly different results. The three famous indicators were never the real story here. How you size the stop is, we just watched it happen. The very same signals went from bleeding at 34% to roughly breaking even near 50% the moment we gave the stop room to breathe. Nothing else moved, so the indicators were never useless, and they were never magic. The edge was simply never in them. Learn them as context, momentum, trend, direction, then win or lose on the part that genuinely matters. 3 honest habits carry more weight than any signal. First, size your stop to real volatility, not a fixed, tiny number a single ordinary candle can erase. Second, trade with the bigger trend, not against it. Third, remember that every indicator only describes the past. It can never promise the future. Here's the one line to carry out of this whole video. The edge is never the indicator, it's the risk. This is educational analysis of history, not financial advice. Always do your own research.